Ellen, appreciate you. Stick around for us if you would. Andrew Levin now with us, former Federal Reserve Board Special Advisor and Dartmouth College economics professor. Good to see you, sir. What surprised you, and specifically what surprised the markets, a dramatic turn upon the news?
Well, I think as some others have said, really this more or less moved rate hikes that the markets were thinking were going to happen next winter or spring now looks like might happen in the next few months. But the markets as of yesterday were already expecting the Fed funds rate to reach around 4.5%, plus or minus a quarter. So I don't actually think that part changed. What I'll tell you, I'm surprised by is the Federal Reserve has been repeatedly making the same mistake now for a year and a half, which is at every point in time to assume that inflation's about to start heading downward. And of course, it's possible that that's a really benign outcome. But I think, for example, their projection for the core inflation rate, excluding food and energy, is that that's going to head downward from here over the next few months just to the end of the year, and then really head down much further next year, so that they're already within striking distance of the 2% inflation target within the next year or so. That's a very benign view. And the risk scenario, which I think is very material, is that core inflation still heads upward further in the next few months. Housing rental costs are going up. Wage compensation, especially in healthcare, is going up. The service sector is really booming. The slowdown that people talked about is mostly in some of the goods sectors, and the supply chains are really relevant for goods. So if the Fed is surprised yet again, and core inflation is actually continuing to head upward instead of down, we're not done. The Fed's going to have to do further rate hikes next year.
Well, Andrew, just looking out to the November meeting, if you take a look at the dot plot right now showing 10-9 majority in favor of hiking above 4.25% this year, making it seem like 75 basis point hike in November is on the table. It sounds like you think that makes sense then.
I think that the Federal Reserve's responsibility is risk management. Now, economists generally think that what really matters for the economy is the interest rate relative to the level of inflation. So that means if inflation's running at 4.5%, 5%, and workers and their families and small companies are expecting inflation to continue at 5%, then even a 3% or a 4% interest rate is not actually that tight. And this is, again, the mistake the Federal Reserve has been making for the past year, and it looks like they may be making again. I think there's a real risk here that the economy will stagnate for sure, almost certainly, over the next year or two. A combination of high inflation and these global developments, high energy prices and so forth. But we should not be thinking that monetary policy is very tight yet. It isn't. And probably, in my view, there's a very significant chance that it'll need to be tightened very substantially beyond what the Fed has unveiled today. Market participants should be prepared for that possibility. The Fed still has quite a ways to go.
And we did hear earlier from Cleveland Fed President Mester this month cautioning over declaring victory over the inflation beast too soon. Or he also downplayed, though, suggestions that the Fed would cut interest rates in early 2023. Is there a disconnect between what the markets are hoping will happen and what the Fed is actually trying to tell people is actually happening?
Well, to be honest with you, I think what I hope will happen at the press conference today is for Chair Powell to explain more clearly what the Fed's strategy is. It's not enough for President Mester, she's great, but for one bank president to stand up and talk in a speech, the Fed itself needs to have a clear strategy and contingency plans, and they should do it right away. If inflation comes down the way they're hoping in these projections today, then maybe they can be close to declaring victory, sometime next year. If inflation stays high at 5% plus, they're going to need to do more, and he needs to prepare the markets and the public for that possibility as well as the benign possibility.
And Andrew, as we put a bow on this thing, you've spoken several times about the repeated mistake from the Fed. So what will make you feel better? What would you like to hear from the Fed chair today that might give you a little comfort?
Okay, people keep talking about the Volcker spirit. Okay, the Fed in the Volcker era raised the federal funds rate up in the teens. Okay, imagine a short-term interest rate in the teens. Up, I think the maximum was at 20%. And the unemployment rate had to rise to 10 percentage points to bring inflation down. The Fed's projections today, the unemployment rate goes up just by a little teeny bit, still below 4.5% at the peak. That's very, very mild. I think what Chair Powell needs to prepare the public and the markets and elected officials for is that a lot more tightening may be needed, and that in order, that's critical to bring inflation back to the target over the next several years. That their work is nowhere close to being finished.
So then, if inflation does remain stubbornly high despite this 75 basis point hike, how much wiggle room does the Fed actually have from this point on?
They have none. They need a plan. They need contingency plans. They need to explain how much further will they go if inflation stays at 5% plus. The projections they released today is a baseline. Okay, that's what they think may be the most likely. We're going to debate about it. Okay, but it's a very benign outcome where inflation already starts heading down very quickly and gets close to their target within the next year or so. And I think they need to address the material risk that inflation stays stubbornly high, which is the service sector is critical to consumers. It's critical to the economy as a whole. And the service sector is where the labor market's very strong right now, and where nominal wage growth is very, very rapid. And so the Fed's going to have to move far enough so that the service sector actually starts to slow down.
Certainly a space we'll be keeping an eye on. A big thank you there. Andrew Levin, former Federal Reserve Board Special Advisor and Dartmouth College economics professor. Thank you for joining us this afternoon.